This is finally a video that I released after loads and loads of people telling me, oh, start a YouTube channel. So it's here, and I've created a full guide on candle range theory. But first I'll be going through turtle soup. So this is a low dopamine guide. It's not spoon-fed, and the only ones who will take this information and become successful with it are the disciplined and dedicated. But this is everything you need to know for CRT and to be extremely profitable with it. So this might be the only video you'll ever need to watch. But anyway, let's just get into it. So, in intro to the breadwinners, what you can expect from us. So what the breadwinners are is we are a team, a group of people. Program, it's free, so I'm not selling any scam course, and a one-on-one mentorship, free one-on-one calls, and paid of course, but one-on-one calls to cut out all your mistakes. And from now on I'll be posting module 1, module 2, module 3, all on my YouTube, explaining everything in depth of CRT, all your questions and answers. You can join my Discord if you want any specific questions and answers, everything on time, everything to yield you the highest win rate possible. Is the basics of turtle soup, the backbone to the model, or the backbone to CRT, and the backbone to ICT as a whole. ICT is the key to the markets, but turtle soup is the key to ICT. And I'll be teaching my own model called the freedom model in one of the next few videos, and that's an exact in-depth guide on how that exact model got me to drop out of school within 1 month of learning it and creating it by myself. So, what is turtle soup? So before you watch this video, I'll have to give credits to Romeo and Sham, because turtle soup is an innovated ICT concept, which wasn't created by ICT, but he innovated it, and then Romeo further innovated it even more, creating CRT. And if you want to learn the art of turtle soup, you'll have to go through Romeo and Sham. And I've used a lot of Sham's videos, loads of his photos as help for this. But it's the holy grail of trading that ICT is rarely touched upon, that is proven to probe the highest win rate if used correctly. It's a false breakout of a range. What do I mean by that? Given a high, a swing high, it trades up to it, an area of high liquidity resting buy and sell orders, and reverses after taking out liquidity of this high. Why it's so good is because it stops out any indicator traders, pattern traders, trend traders, support and resistance. All the retail traders will treat this as a breakout and go long, and all their stops will be used as liquidity to then get a huge smart money reversals to the downside, and vice versa. It's a stab above an old high prior to a reversal, prior to an expansion. It's a stab below an old low prior to an expansion in the opposite direction. Every move in the market happens because of turtle soup. Every PD array is a lower time frame turtle soup. So when you think market is reacting off of a PD array, it's actually reacting off of a turtle soup. So another thing is, stop pattern trading ICT concepts. Look at the markets with the real eyes of turtle soup, and instead of random PD arrays and hoping that price will go there. Because turtle soup is the logic behind all PD arrays. For example, the higher time frame PD array fair value gap is just a lower time frame lows and highs. So price doesn't draw to fair value gaps, It draws to lows and highs and liquidity pools where it can turtle soup. And every expansion move in the market that you need to be taking are because of turtle soup. So if you look at the market in the eyes of turtle soup instead of PD arrays, you now unlock a whole new perspective and the truth to seeing the market. So filling out inefficiencies and balancing price is bullshit. It's just another way of turtle soup. And the manipulation takes out resting liquidity buy and sell stops of retail traders at the swing highs and swing lows, then acts as a catalyst for price to reverse. That's turtle soup. Takes out an old high, takes out the sell and buy stops, uses that liquidity to act as a catalyst to reverse. Now, market structure shift versus turtle soup. Don't rely on market structure, otherwise you'll fall victim to turtle soup and higher time frame bias. Another reason why not viewing the market in the eyes of turtle soup will stop you out. When price is above or below a previous high or low, don't assume it's a market structure shift. Get that concept out of your head completely. Market structure only works in the correct bias. So a lot of the time you just see a random high being taken out and you think it's a market structure shift. And then you get stopped out by turtle soup. You get turtle souped. Now why didn't this work? Something may look like a market structure shift or a break of structures, if that's what you want to call it, but actually it's a turtle soup. It will only work if the correct bias is probed. Even though there was a fair value gap on the lower time frame turtle soup, price just cut through that. It broke through that range. It inversed this fair value gap because of the directional bias. So how do we formulate bias? Well, I'll explain most of that later, and I'll have another video on it, but right now, next. So before you properly indulge in learning turtle soup, you must learn how to learn turtle soup. So you've already learnt the importance of turtle soup, but now you must enter this market experience with a clear mind and a blank slate of any previous ICT knowledge. Forget the patterns, forget the SNR indicators, all of it gone. The only thing you need in this market to effectively, objectively, and simply get a high win rate is look at the market through CRT and turtle soup. Okay, so understand the rules for turtle soup. Buy low, sell high. You're like, okay, of course that's obvious, right? But you have to think about it. Never sell below a low and never buy above a high. It will drastically increase your win rate if you avoid these things. Take into account the market profiles, because if you just pattern trade turtle soup, then you're going to get stopped out, because turtle soup only applies in the direction of the market. Say we're trending to the upside. We're not going to look for bearish turtle soups, are we? Always monitor higher time frame price action, and always be on the lookout for SMTs. SMTs is just a turtle soup on the other correlated pair. And always monitor higher time frame price action. That way you'll never get stopped out in a turtle soup. Market profiles. The market can only move in two ways. It can either range, where the market consolidates or it accumulates, as ICT says, or it can trend, where market expands and distributes, right? A bullish trend, or where lows are being rejected and highs are being broken through. Lows are being rejected, highs are being broken through. A bearish trend is where highs are being rejected, they're being turtle souped, and lows are being broken through. When bullish, we want to see lows being rejected. It shows the intention of going long and rejecting highs. And highs being broken through shows a continuation of that intention, instead of some bullshit market structure shifts. Only look at the market in market profiles, CRT, and turtle soup. And remember, the first breakout of a range is usually fake, which is a turtle soup. Here's an example of that. This is a range, right? We're ranging. And the first breakout of that is fake. It's a turtle soup. And then boom, we go long and huge distribution to the upside. right? Remember that a range and trends aren't always this clean looking. Obviously, everything that I tell you has to be back tested and has to be applied to your own manner. Because you've seen all this information, but you're not applying any of it. All the juice and all the profitability in trading doesn't come from the content that you watch. That's a small part of it, but it comes from you actually applying it. And I'm telling you, you need to apply it, right? A higher time frame bullish trend has lower time frame bearish trends and ranges. So in a high time frame bullish trend, we're getting retracements. Within those retracements, those are lower time frame bearish trends within themselves, right? A manipulation leg could be classed as a lower time frame trending expansion itself, right? Price is fractal. You don't just take longs on the weekly. If you're entering on the 1 minute, then you can use the 15 minute, 1 hour, the 4 hour as your bias. Like ICT said, use the 4 hour and the 1 hour candle and treat it like it's the daily candle, and a whole new world will open up to you. Candles range theory, CRT. Right, I'm finally getting onto CRT, but CRT is useless if you don't understand the basics of turtle soup, which I just taught you, right? Visualize candles as ranges. Every single candle is a range on every time frame. Remember, price is fractal. And so you can see here on the right, this candle on the daily time frame can be looked at by all these 5-minute candles. Same with this. Every candle has an open, high, low, close. On the right is a visual representation of these candles, and I'll go into detail this on the next slide, right? The top two are expansion candles, and the bottom ones are ranging candles. Some candles are higher probable than others. Understand that, right? So how do we apply this to turtle soup? Well, the key to bias is to ask if the higher time frame candle, let's say the daily or the 4-hour candle, has been turtle souped or not. So what does that look like? So if we get a close above the previous candle, this normally applies to the daily or the 4-hour candles, then we can expect higher prices. Obviously, you have to take into account the higher time frames on top of this and the market profiles, etc. But literally just using this by itself, you can probe a 65% win rate on your bias, just using whether it's closed above or it's wicked above, or closed below or wicked below. Just using this. If we get a close below the entirety of previous candle, we can expect lower prices. If we get a wick above previous candle, then we can expect lower prices. If we get a wick below the entirety of this previous candle, we can expect higher prices. Because this is what a turtle soup looks like on the CRT candle ranges time frame, right? Turtle soup doesn't just look like a bunch of candles being taken out. It can be represented as two candles. This isn't a turtle soup. This is a breakout of this range. But if there's a candle here and it wicks above it but closes below the candle, then that is a form of a turtle soup on the higher time frame. CRT makes it really easy to frame a bias. It's objective. Now, CRT x power of 3 in AMD. You must understand this. There's 3 stages that price is delivered in the charts. That means you only need 3 candles. The first candle forms the range. That doesn't necessarily mean it's ranging. It just forms the range of price that's going to be used to be turtle soup or breaking through. Second candle is the turtle soup. Here. It wicked below previous candle. That shows it turtle soup's previous candle, and we can expect lower prices. The advanced only trade this candle, because with trading candle 3, which is the distribution candle, the highest probability candle, you have confirmation that the second candle turtle soups the first, and so now you know price has to go to at least 50% of the first candle's range, or to the end of it. However, if you trade the second candle whilst price is live on the second candle, you don't know whether it's going to close above or close below. That's where you go to the lower time frames, and I'll be teaching everything about CRT's intricacies and Turtle Soup's intricacies with time intricacies, and how you can enter every single market condition of AM session on NQ, on the Nasdaq, or on any indices with my freedom model, which will be within the next 2 videos. But understand this: every single price move happens from Turtle Soup. We've established that every expansion, every huge price move, what is there a pattern? Yes. Every single price move, every single expansion happens because of Turtle Soup prior. Because why does market move in the first place? Market moves, if we think like smart money, market moves to buy the sell stops at lower prices at previous lows to then go long and rally upwards. It hunts liquidity pools, it hunts lows and highs, so it then can expand off of them. That means every candle has a power of 3 because every single price move has a manipulation. Here you can visualize it, right? The first candle here, we see accumulation, generation of interest. Then we get the manipulation, which is the turtle soup of that first candle, of this accumulation. And then we form an order block. We come down, we tap into this order block, and then on the third candle we get a distribution. I recommend trading this candle. Oh shit. Fuck. This is not meant to be added. Okay. Fuck. CRT X power of 3 and AMD. So here's a better visualization. Open, high, low, close. Every single candle has an open, high, low, close. Right? This is a bearish candle. This could be viewed as the black candle. It opens here, where price of that specific time range of this candle trades the highest to is the high, and then the lowest, and then the close of this whole candle. Same with here. The open, low, high, close. And within the open, high, low, close of each candle, there is the power of 3 in AMD. So what does that look like? Do you know how I said every single candle has AMD, the power of 3? This is the exact visualization of that. The first candle, which forms the range, accumulation, manipulation that turtle soups this range, boom, distribution. And that's only just the first candle. This second candle, accumulation, manipulation, takes out first candle and takes out this pre-manipulation liquidity pool before expanding off. And then we get a range, a turtle soup expansion. And then we get the kiss of death, which is the last turtle soup prior to the final drawn liquidity being hit. And then we get a classic buy candle, right? Open, we open, let's say this is a daily candle. A classic ICT buy candle, an expansion candle, will look like this. Price opens, and for Asia it consolidates. Then in London we form the low or the high of the day, where we turtle soup Asia's range, or turtle soup another key level on the previous day, or the previous week, whatever it be. And then we expand. And then New York session is we return to OTE of that price range, and we get another turtle soup before expanding off higher. Classic sell candle. And this is where you want to see your key levels. Do you know how people say buy below the open and sell above the open of the candle, right? You want to be selling, if you're taking shorts, you want to be selling at this wick. We sell at the wick. We don't sell below where the wick's going to close, right? Here, we sell in this area. So we sell, we buy in this area. We buy here. We buy below the opening. And we sell above the opening. So the 3 candle model. Obviously the first candle forms the range. Wait until this forms. Mark out the high and the low. This candle will either be turtle souped or it will be broken out of. Advanced traders only trade the second candle. But I will be teaching you how to enter this trade and the intricacies of timing into the markets and everything like that. But this is just the basics of CRT and how you can understand it on a good level before you actually apply it to whatever you're trading, whether it be Forex or indices. I can teach both. I'm going to be teaching both on next video. The third candle will normally be the distribution, which is the highest probability, obviously. When you're bullish, you enter below the opening candle of the candle you are trading. When you're bearish, you enter above the opening candle of the candle you're trading, right? You are trading the bottom or the top of the manipulation, and this avoids you getting stopped out. See, these are just examples. First candle's the range. Second candle, it wicks below. It doesn't close above. So this shows that this total sweeps this price range. So we can expect higher prices. At least, which is 100% guaranteed to 50% of the first candle's range. Even if the bias is wrong, you can still probe high win rate trades. If the second candle total sweeps the first range, then it will at least go to the 50% candle of this first candle's range. And where we see a turtle soup and the three candle model, we also want to see a higher time frame key level, which acts as a catalyst to move in the opposite direction. This is another example. Turtle soup, we wick below. Oh, sorry, we wick above, close below, lower prices, 50% of the range already hit. Boom, up opposite end of the range. This is an inside bar. It doesn't do anything. Boom, we turtle soup. And sometimes the candle that turtle soups the first candle's range will also just hit the end of the first candle's range itself. Sometimes the second candle already goes to the end of the first candle's range. So be careful of that. And I will teach you how to enter on the second candle, which Romeo and Sham do not teach. So the three candle model, this is just a quick example of a live trade that I took. So we see here, these are the 4-hour candles. We mark out the high and the low of the first candle. This happens to be a ranging candle, so it's consolidating, generating interest, accumulation. And then the second candle, manipulation, we wick below, sorry, and we close above. We turtle soup the first candle's range, meaning we can expect higher prices, and the third candle to go to the end of this first candle's range. That's on the 4-hour. On the 1-hour, you can visualize it like this. 8 a.m. high and low. This is the 4-hour high and low. So it takes up both the 1-hour high and low, the lower time frame CRT, and the higher time frame CRT. Mark out the first candle, wick below, close above, higher prices. So we can enter on the 10 a.m. candle with a bias of going up. How simple is that? Boom. We form a range. This is the 4-hour high, 4-hour low. Then we get 8-hour generating interest. We turtle soup the 8-hour low and the 4-hour low with SMT, confirming that it's going to be a catalyst for reversals at a key level. And then we get a change in state of delivery, which causes this order block. And at the 10 a.m. candle, we already have confirmation that the second candle turtle soups the first range. So now we can enter on the third candle with guaranteed confirmation that it will go to 50% of the range, at least, even if the bias is wrong, of the first candle. And as we see here, enter on the order block, target these highs. Insane RR. So let me just describe to you the importance of CRT. ICT has different concepts, and many of them are pattern traded, misinterpreted, and overall stirred. That makes it easy to get confused. CRT is simple, it's objective, and it's efficient, especially when you add market profiles, higher time frame bias, higher time frame CRT, and look for your CRT protocols. Simplicity scales, complexity fails. Every single day you will find a trade entry. Now, what are the protocols of CRT? How do we look for our high probable CRT, because all I've taught you right now is turtle soup, a bit of high time frame bias, and the structure of how CRT works. Now you need to know how to apply it, and I'll be teaching that right now. So now we need to understand selecting the right CRT. Now that you understand turtle soup and the dynamics of CRT, you may ask, well then how do we apply it, and how do we look for high probable entries? So we have protocols for CRT, which I'll be going through and you can read now. I recommend looking at Sham's videos and Sham's Twitter link, which he goes into this detail, but this is another interpretation of that. But I would recommend using multiple sources, me, Sham, and Romeo. It's all just a regurgitation of the same knowledge, but I just want to share it in my perspective because I think my perspective is the most understandable. Now, macro micro CRT. Pairing different CRTs in the same time frame for extra confluence, the price will continue in the direction of the macro CRT. So what you need to do is identify the macro CRT to see which side has been purged. Then we use the CRT turtle soup from the macro CRT to determine the bias and drawn liquidity. Once we find the bias and the drawn liquidity from the macro CRT, then we can use the micro CRTs, which is inside of the range of the macro CRT, to confirm the direction of the drawn liquidity. So we get this huge big dick candle right here, Johnny Sins cock candle. Then we turtle soup this range, wick below, close above, expect higher prices. That's the macro CRT. Now our drawn liquidity is to the 50% range of this candle or to the end of this candle, depending on if our market profiles are bullish or not. Clearly they were, because this trade worked out. And so we continue up, and then within that price leg, we get a micro CRT, which is a CRT confirming the drawn liquidity of the first macro CRT. It increases your win rate by 40%. I've backtested it. Even Sham says this. Right, this is another example. High time frame CRT, turtle soups, but it's also within a lower time frame, or sorry, a micro CRT. So our first drawn liquidity can be here, our second can be here, right? A 3 candle model CRT within the bigger CRT move. Now, key levels. Key levels are probably the most important protocol for when looking at a higher probable CRT. Key levels are a hotspot for price. They act as a catalyst for expansion when price reacts off the correct ones. The correct ones. Oh, so what's a correct PD array? A correct PD array is a PD array that price reacts off of that's within alignment with the higher time frame bias, right? Because institutional order flow says that if we're in a buy program, if our order flow on market profiles is bullish, then we'll disrespect bearish PD arrays and respect all bullish PD arrays. Whereas if we're bearish, we'll disrespect bullish PD arrays and respect bearish PD arrays. So you need to don't just mark out random key levels, right? Key levels can include PD arrays. The important ones to focus on include significant highs and lows. Those themselves are more important than order blocks, rejection blocks, fair value gaps, and breakers. They work the most efficiently when time frames are aligned. For example, if I see a CRT on the hour 4 candle, then I use the daily time frame for the best key levels. The time frame above the CRT for key levels is the best time frame to use. On indices, you'll see less key levels and more jumpy price action. On Forex, this works incredibly well, but it still works for both. Now, let me give you some examples, right? This huge rejection block, price takes out this previous high at a key level to then expand lower. And this was a manipulation move because our market profiles are bullish, but we can still catch a huge expansion to the downside on this manipulation move. And then we get this huge order block here. We take out this low, and this low at this order block, and then we boom, rally up. This is another example. A significant low, previous week low, previous day low, followed by a previous candle's low being taken out, wicked above, boom, rally to the top. And this is an example where the second candle under takes out the range of the first candle. Instead of the second candle just being the total soup and the third candle distributing, the second candle distributes. And I'll be going into detail on how you can enter on that on the next video. But for now, this is just an understanding of CRT. Now, key purge and formation timings. Remember, time, then price. Time is better than price, right? By understanding the importance of time, we can filter out the low probability trades. Because most of you are getting stopped out because you're not entering at the right time, right? You're just a fucking idiot. You can find all the ICT confluences in the world, but if it's an Asian session, for example, you're getting fucked. Time importance goes deeper than sessions. Certain times of the day, time cycles, are prone to AMD. However, I'll go more in depth in another video. For now, this is all you need to become profitable, and all you need to even probe like a 65 to 70% win rate just with this, right? Simplicity scales, complexity fails. For now, understand the hour 4 candle is optimal for CRTs, both on Forex and for indices, and the most important ones that form are at different times of the day. You may have heard the phrase 159 or 369. You've heard these, right? Well, the daily candle is split into 6 4-hour candles. And the most precise and accurate CRT candles form at New York time, obviously, 9 p.m., 1 a.m., and 5 a.m. For indices, that's 10 p.m., 2 a.m., and 6 a.m. I should have added that, my bad. Whilst the most accurate purging times for the hour 4 are 3 a.m., 6 a.m., and 9 a.m. For indices, it's 3 a.m., 6 a.m., and 10 a.m. Right? And here's an example. This is on the previous slide where we CRT plus a key level at this rejection block. But also at this key level, with the CRT, we turtle soup this high probability CRT formed at 5 a.m., which is high probable. And then we turtle soup it at a higher probable time. We purged it at 9 a.m. And then we go lower. So what do we have here? We have classic 3-candle model, or actually this is probably like a 7-candle model, but you know what I'm saying. We get a CRT at a key level, and we form the candles for the CRT, and we purge the first candle's range at specific times, high probable times. Now, this is probably my favorite thing to do when trading CRT. This will probe you the highest accuracy among them all. First, you look for the CRT on the higher time frame, macro. Then you look for the CRT to be at a key level. Then I go from the higher time frame CRT to the lower time frame CRT because it's the most high probable thing. Okay, so in my opinion, this is a must before any criteria. Seeing a lower time frame CRT within a higher time frame CRT confirms the directional bias, confirms the direction that the higher time frame drawn liquidity probes. It increases the probability of your trades the most out of all of them. So first, it's to identify the correct CRT, the turtle soup, within the protocols at the right time, at a key level. Then look for the lower time frame CRTs to be turtle souped, and even more lower time frame CRTs to yield the highest RR. Because if you go from lower time frame to lower time frame to lower time frame, so the 15-minute all the way to the macro 4-hour CRT, then the 15-minute is confirming the direction of the 1-hour CRT. The 1-hour CRT is confirming the direction of the 4-hour. So that means you can take 1-minute entries. You can take trades on the 1 minute to form 1 minute risk of, I don't know, a few pips to higher time frame reward to target 4-hour highs, which can probe you the highest win rate. Now, inside bars. Inside bars are where price isn't really taking out a high or a low of the first candle's range of the CRT. They're just inside bars, like you can clearly see, right? Inside bars are significant for high probability CRTs, and you'll find these more on Forex, but it's still extremely useful on indices. It's the accumulation, or let's say the generation of interest around a CRT, and because of this, the more inside bars there are, the more generation of interest there is, the more accumulation there is, the better the CRT purge will be. Meaning the more explosive the expansion after the total soup, which is slash purge. They indicate the accumulation phase, followed by the manipulation phase, which is the total soup, and then the explosive expansion. Let me give you an example. This is the hour 4 time frame, and obviously you can't identify all the protocols because I don't give you the timings, I don't give you other things, but screenshot this now and pause it and analyze every single protocol you think you can mark out and you think you see. So, obviously all the criteria isn't in here because obviously you didn't see the times, so you didn't know when it was going to be purged or not. However, mark out the first candle's range high and low, the 50% of it. We can clearly see generation of interest, then the total soup, and then within that total soup we get micro CRT within the macro CRT, and we generated interest, meaning we get explosive moves to the upside, especially to the 50% range minimum, even if the directional bias is wrong. And at the 50% range, we get a turtle soup at OTE, which is obviously 50% of the candle's range, which is at New York time to continue the direction all the way to the end of the first candle's range. So we get macro CRT, CRT formations and purges at specific times. Inside bars are draws on liquidity and our OTE turtle soup, which is a micro CRT within itself to confirm the directional bias of this macro CRT. Now, how do we enter on this? I'll be teaching you the entry system, which we call the sequence. Combining CRT, now that you understand how to select the correct CRT, you understand the importance of it, what CRT is, what turtle soup is, how you can apply it. Now you need to know how you can apply it to entry systems. And I'll give you the entry system that happens every single day of every single price move. Every single price move has the sequence, so why are you not using it? Because you don't know about it, right? Combining CRT with the sequence, everything begins with the turtle soup and everything ends with the turtle soup. Remember that. The sequence objectifies and simplifies entries. It's an entry system that plays out on every expansion, so you'd be a fool not to use it. It consists of different steps that play out in the lower time frame to trade every higher time frame CRT range. It includes CRT total soup, which is the first step of the sequence, right? We get this total soup. Then we get the change in state of delivery, which creates this order block where we can enter off of, which is the second entry. Then we get OTE. At OTE of the range that we're trading, the first candle's range, we'll get another turtle soup, which can be on the higher time frame or it can be on the lower time frame. Then we get a continuation of that from OTE. Then we get what we call the kiss of death, which is the last turtle soup prior to the final drawn liquidity being hit. And here it's the CRT high, right? And then obviously we get a turtle soup at the end of the CRT high, and we might continue lower or up. It depends on the bias. An example. You can spot out your own CRT. Say we see macro CRT, micro. We got a generation of interest within this one. Total soup, boom, up here. Whatever. Analyze this by yourself. But then actually applying this, right? We turtle soup this low. We get the turtle soup, which is our first entry. Then we get the order block, which is the last candle that takes out the previous low or high, then gets traded above and closed above, which liquidates this candle, which turns it into an order block, which then is a catalyst for price action to react off. And that's the second entry. Then at 50% of the first candle's range, we get a turtle soup, continuation of that, and then the kiss of death, the last turtle soup prior to the final drawn liquidity being here. Another example here. Turtle soup, order block, kiss of death entry, which is actually at OTE as well, so this could be arguable, and then last turtle soup. Now, that's it for now. I'll be posting a part 2, and anything that you want to see from me, I'll post anything. I'm going to be doing in-depth guides on everything you need to know about my strategy that made me drop out at 17, and that's the freedom model, which is entering at New York AM session on the Nasdaq or any indice, and how to enter using any market condition, using time cycles, time manipulation, how to reduce your losses, how to increase your wins, everything. An in-depth time video, an in-depth ICT concepts video, and an in-depth bias video, and live examples, walkthrough, Discord calls, everything you need to become profitable, I will give it to you. And I will give you a shortcut to profitability. And how is that? Well, in our Discord, it's free. If you just get 5 invites, you get access to all of my private videos, which I won't be posting on YouTube, and you get access to one-on-one mentoring. This is a shameful plug, but this one-on-one mentoring, I can answer any of your questions, and you can directly speak to me, right? ICT said himself, a one-on-one mentor is a shortcut to profitability. It's a shortcut to success, because you'll learn by yourself, but instead of taking months to figure out a mistake, a mentor can just cut it out instantly. He can give you a direct path, personalized for you, on how to get to the shortcut to profitability in the quickest time possible. But yeah, that's it for today. Join the club. Thank you. More on our Discord. Fuck off.